The end of 2024 is fast approaching. I know it's quite a dramatic sentence to start a video with, but it's true. 2024 is coming to an end. It's been a pretty good year for the stock market for investors. 2023 was also a pretty good year. So let's see what 2025 will bring us. This video, we're going to touch on 10 companies. Some of them I personally own, some others I do not, but I do think that they will perform quite well in 25 and onwards. Now, just because I'm talking about these 10 companies does not mean that you cannot like other companies. If you have any suggestions, let me know down in the comment section below. And of course, I'm not here to waste your time, so the names will pop up on your screen. I do hope you keep watching so YouTube recommends this video to more viewers. And if you're new here, maybe hit the buttons, subscribe, like, would really appreciate that. Still a couple of days left. Maybe we can reach 70,000 subscribers, maybe not. It's worth a try, so hit that button, it's free. Anyways, if you want to support me even further, do check out the link down in the description and the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much, and happy holidays and happy new year to all of you watching. So company number one I want to touch on is Google Alphabet. Each and every company we're going to touch on, we're going to do a major overview what the analysts are expecting these companies to do in fiscal 25 and 26, the average analyst price target as well, and a couple of pricing metrics. So company number one is Google Alphabet. Of course, year to date, this stock is now up 40%. There was quite a long period of time where it did underperform. They had their own issues, plus the market was not really thinking that Google was competing with all the other AI players. But yeah, as you know, we've covered Google quite a lot on this channel. The market was just wrong. Right now, Google has a market cap of $2.4 trillion, a forward PE of 22.9 times. If you look at what the analysts are expecting this company to do in fiscal 25 and 2026, these are the numbers: sales growth of above 10% and EPS growing above 12 and 13% in both of those fiscal years. Looking at the current average analyst price target, that sits just 7.6% higher than the price we're at right now. Looking at some pricing metrics, forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, we can see that currently forward PE is lower than the 5-year mean. But then if we look at EV to EBITDA, price to sales, price to free cash flow, that is actually now higher than the 5-year mean. Price to free cash flow is here last 12 months. I expect the next 12 months to be much better. So you might say, okay, might not be as cheap as before. But I mean, if we look at price earnings to growth, 1.39, that's definitely not expensive, especially not for a company like Alphabet. And of course, this is a company that buys back quite a lot of shares and pays a small dividend. Looking at what the market expects this company to do with regards to free cash flow, well, in fiscal 24, free cash flow is expected to grow 8.6%, followed by, well, an accelerated growth in fiscal 25 by 19.5%, and then another 15% year-over-year growth in fiscal 2026. Free cash flow is expected to reach $103.6 billion. And as you know, the majority of their revenue gets generated from Google Search and other revenue. Then we've got Google Cloud, which is growing quite quickly. After that, Google subscription platform devices revenue, YouTube ads, and Google Network. Now, looking purely at Google Cloud, you can see here how fast this one is growing and now becoming more and more profitable. Last quarter, Google Cloud did grow 35% year over year, but it was a pretty easy, let's say, year over year comparison, but it's been accelerating for the last couple of quarters. Moving on to company number two on the list, and this is just a list, these are not rankings. Number two is dLocal. Now, dLocal is a company that is much smaller, a market cap of $3.31 billion and a forward PE of 21.8 times. Year to date, the stock has underperformed by quite a lot. It's down 34.37%. Yes, it's true that in the last 3 months, we've seen a solid rebound, up 43.3%. Here, if we look at what the analysts are expecting this company to do in fiscal 25 and fiscal 2026, sales growth close to 27% year over year for both years, and EPS growing 32.7 and 37.3% in fiscal 25 and fiscal 2026. This is a fast growing company and a profitable one as well. Currently, the average analyst price target sits 3.69% lower than the price we're at right now, which to me is quite strange. We've also heard in the last couple of days some rumors about, well, dLocal looking to get acquired. I would find it quite disappointing because I personally own dLocal and I think this company should be worth way more than 3 point something billion dollars. And if they do get acquired, I hope they get acquired with a nice premium. Looking at some pricing metrics here, forward PE, EV to EBITDA, price to sales, price to free cash flow, all below the 5-year mean. Price earnings to growth is quite high right now, but remember, fiscal 24 is a year where they have invested quite a lot, so that's why earnings and margins did get hit. Last quarter, we have seen a small rebound. And that's also why currently the market expects free cash flow to be negative in fiscal 24 and fiscal 2025. I think they'll surprise on the upside. dLocal, of course, is a company that operates or generates their majority of their revenue from Latin America, but also from non-Latin American countries such as Egypt and Nigeria. Now, of course, with, let's say, issues in Brazil being a big part of their revenue, yes, there is definitely some risk here. Emerging markets are always more risky than others. But as you can see, over the years, TPV, total payment volume, has exploded. Since 2019, it's up by 1,683.9%. And I do think that with the revival of Argentina, I think this company will be one of the companies in those regions, Nubank, Mercado Libre being another one, that would benefit heavily from that. Moving on to company number 3, and that's a company we recently touched on, and that's Novo Nordisk. Yes, there is a reason why the stock got hit heavily last week. We've touched on that on the channel. If you missed that video, it's going to be in the top right corner. Basically, they came out with results from their latest trials, their latest weight loss product. They were targeting 25%. They reached 22.7%, I believe. And so that's why the company lost close to 20% of its value last week. Now, Novo Nordisk has a market cap of $378.4 billion, a forward PE of 23.3 times, pays a small dividend as well. The dividend yield sits at 1.17%. If you look at what the analysts are expecting this company to do in fiscal 25 and fiscal 2026, clearly this is still a company that is expected to grow quite quickly, sales and EPS. If we currently look at the average analyst price target, that sits 43.4% higher than the price we're at today. Of course, you might say, okay, Novo Nordisk is a great company, but I'd rather go with Eli Lilly. And I'd say, okay, that's a, let's say, good alternative. Looking at the usual pricing metrics, all of them are lower than the 5-year mean. Price to free cash flow, that's in the last 12 months, that's basically the same, 34.9 times compared to 33.5 times, and price earnings to growth sits at 1.21. And here, if you look at what's expected to happen with regards to free cash flow, in fiscal 2025, free cash flow is expected to grow by 38.4%, followed by another 27% growth in fiscal 2026. For the rest, I highly suggest you go watch the Novo Nordisk video for more information. Moving on to company number 4, we're staying in Europe, and that's LVMH, another one of those incredible companies that, yes, did get hit this year because, well, the luxury market did get hit. China got hit, and since China is quite a big part of their consumer base, the company got hit a little bit. Now, we did talk about LVMH, we talked about Ferrari, Hermes in other videos on the channel as well. So I suggest you go watch those for even more information about European stocks. But LVMH right now has a market cap of $327.5 billion and a forward PE of 22.1 times. If you look at what the analysts are expecting this company to do in fiscal 25 and 26, we can see that 24 is the year where they took a hit, sales and EPS. That's expected to be better in both of the following fiscal years. Looking at the average analyst price target, that now sits 9.32% higher than the price we're at today. And as you can see, the average analyst price target did come down. Why is that? Well, as you can see, the stock has gone down as well. So yeah, I guess they have to follow the price. Looking at the pricing metrics, of course, if we just look at price earnings to growth, 10.71, extremely high, but we know why that is. All the others are much lower than the 5-year mean. Looking at free cash flow growth, we can see that in fiscal 24, free cash flow is expected to grow 12.4%, then 12.8% in fiscal 25, and then another 7.8% in fiscal 2026. Now, they generate their revenue through various businesses. The largest chunk comes from fashion and leather goods. Then we've got selective retailing revenue, watches and jewelry, then perfumes and cosmetics, and then the smaller part here is wine and spirits. Now with these types of companies, of course, you can wait until the major economies do recover, or you can buy when there is weakness, and then dollar cost average, allocate accordingly, and make it a solid position, because I don't think that LVMH will disappear anytime soon. This is one of those companies that will stay around and has been staying around for quite a long time. Up next, we're going back to Latin America because we have to talk about New Holdings. Now, New was up at one point 90% year to date. Since then, the stock is down around 30% or so. It now has a market cap of just under $50 billion and a forward PE of 18.8 times. Now, a forward PE of 18.8 times for a company that's expected to grow this quickly in the next coming fiscal years is quite ridiculous. Now, of course, there might be some headwinds coming their way because of Brazil. But then again, if we look at the previous examples that I gave in the other videos about New and Mercado Libre, these companies became bigger and better despite the struggles in the region. Despite the previous struggles in Brazil, in Argentina, these companies became bigger and bigger and bigger. So yeah, maybe short-term headwinds, but long-term, I believe this is one of the best companies that you can buy from Latin America. Looking at the average analyst price target, that sits close to 50% higher than the price we're at right now. Looking at the pricing metrics, it comes at no surprise that we're lower than the, in this case, 2-year mean. Now, of course, with New, the majority of the revenue does come from Brazil. Then you've got Mexico, Colombia, and of course, they'll develop in other countries along the way. But right now, the big chunk does come from Brazil. If you look at the number of customers, that grows at an extremely fast pace. Of course, I can talk about New way more, but like I said, I've covered this company quite a lot on the channel. Currently not holding any shares, but that might change if the stock keeps getting hit and the business continues to do well. Moving on to the next company, and that's a company that we have to go to another continent. We're going to Southeast Asia this time. I know Southeast Asia is not a continent, but Asia is. So this time we're talking about Grab Holdings. Yes, I've recently talked about, I think in a month or two ago, we talked about Grab. Year to date, the stock is now up 46.5%, has a market cap just under $20 billion. Now, with Grab, what you get is also a fast growing company, top and bottom line. Now, bottom line in fiscal 24, still EPS negative, a loss here, but that is improving quite quickly in the next 2 fiscal years, or at least that's the expected rates, or at least that's what's expected. Looking at the average analyst price target, that sits 11.8% higher than the price we're at today. And then looking at some pricing metrics, we are lower than, 3-year mean, 2-year mean, depending on which pricing metric you are looking at. Yes, forward PE for this company is at 164.7 times, but there's no reason to look at forward PE right now since, there was no E before. For companies that have been unprofitable and just became profitable, looking at PE just doesn't make any sense. Give this company time to prove to you that they can become more and more profitable over time. Looking at free cash flow is expected to grow by 24.8% in fiscal 25 and then another 10.8% in fiscal 2026. Grabs generate revenue through a couple of businesses, one deliveries, second mobility, and then the other one is financial services. As you can see, financial services is still small but growing quite rapidly. Since the March quarter of 2023, it has grown by 77.78%, while mobility has grown by close to 40% and deliveries by close to 30%. Now, of course, you might say, yeah, but Grab only plays in that part of the world. Yeah, that's true. But the amount of people that live in that part of the world is quite big. Quite big. And I believe that market still remains, let's say, I wouldn't say unmonetized, but the monetization part of it can be much better in the coming years. Plus, Grab is not just another Uber. By the way, Uber did sell their Uber of Southeast Asia to Grab to get, I believe back then was 27% stake in Grab. Now it's around 14%. So if you own Uber, you own a part of Grab as well. But Grab is not just an Uber, it's basically an all-in-one app, as you've seen, right? Delivery, mobility, financial services. So you go, you open the app, you can basically do all of it in just one app. And so the monetization part of it, I think, will become better and better in the years to come. Up next is a company that doesn't really need any introduction. That's Amazon. It's my second largest position in my main portfolio. Amazon is up 50.75% year to date, has a market cap of $2.4 trillion, a forward PE of 39.1 times. You might say, oh, that's extremely expensive. But if you look at what this company is expected to do in the next coming years, well, the bottom line is expected to grow at double the pace of sales. Looking at the average analyst price target right now, that sits 4.74% higher than the price we're at today. And then looking at the pricing metrics, like I said, you might think that 39.1 times forward PE is expensive. But price earnings to growth sits at 1.76, which is definitely not that expensive. And that's because this company's bottom line is just becoming better and better. We've seen cash from operations increase quite rapidly before we actually saw free cash flow. And now this is becoming a free cash flow generating machine. As you can see, free cash flow is expected to grow 48.9% in fiscal 2025, followed by another close to 40% year-over-year growth in fiscal 2026. Now, if we look at what's happened with Amazon's businesses, right? How do they generate revenue? Online stores, physical stores, third-party seller services, advertising revenue, subscription services, and AWS. We can see that the high-margin businesses are growing much quicker than the lower margin ones. And that's exactly what we've been talking about for the last couple of years. It was only a matter of time until Amazon became free cash flow positive and, well, a free cash flow generating machine. Now, of course, with companies like Amazon, many people might think, how much bigger can it become, right? Well, as we've seen, we've been asking this question probably for the last 10 plus years, right? How much bigger can this company become? And then we had $1 trillion company, 2, then 3, then 4, then 5, and many, many more in the future. So yeah, bigger can become bigger, especially in this day and age of AI. I think these companies will just become bigger and better in the future. Moving on to another company, and that's a company where I did hold shares. When I held the shares, I was quite critical of that company. Then I sold because, well, I've had enough of it. But I do think that the last couple of quarters, they did turn the corner. And that's Block, ticker symbol SQ, previously Square. Now, this company, this stock is up 17.75% year to date, has a forward PE of 21.7 times and a market cap $56.45 billion. Now, this company, sales growth is expected to remain the same, around 11% year over year for the next coming fiscal years, but EPS here is growing much quicker. The issue with Block was that, well, they did not really care about creating shareholder value for quite a long time, right? If you look at what has happened with the stock in the last 3 years, it's down 45.6%. In the last 5 years, it's up only 45%. But the last couple of quarters, management did realize that, oh, we are a publicly traded company, so it's about time we start returning some value to shareholders. Looking at the average analyst price target, that sits 6.7% higher than the price we're at today. And then the pricing metrics, and this is why this company sits on this list. If you look at forward PE, EV to EBITDA, price to sales, price to free cash flow, all way, way lower than the 5-year mean. And then if you look at price earnings to growth at 0.56, this is extremely, extremely cheap. And looking at free cash flow growth, in fiscal 25, free cash flow is expected to grow by 14.1%, and then an acceleration in fiscal 2026 by 20%. Looking at how this company generates revenue, this is revenue, not profits, because we've seen that revenue can fluctuate quite a lot, especially with regards to Bitcoin revenue. As you can see, back in 2021, Bitcoin revenue was $3.511 billion. Might be quite high in the coming quarter as well because of the price of Bitcoin, but that remains to be seen because you would have thought that would have been much, much higher in the last couple of quarters as well. But all in all, what's important is to see the other segments grow, right? Transaction-based revenue, subscription and services, and then you had hardware revenue as well, but that's a tiny, tiny part. And then you can also see Cash App monthly transacting actives that has grown throughout the years, although it's been quite flat in the last couple of quarters. Now we've just seen revenue, but what about gross profit? Well, we can see that gross profit, especially gross profit margin, has reaccelerated in the last couple of quarters. We've been at 35.5% in the March quarter, then 36.6%, and then the last quarter, 37.9%. The big part comes from Cash App gross profit and the rest from Square. As you know, I'm not a big fan of Jack Dorsey as CEO of a publicly traded company. I think he's a great entrepreneur, just publicly traded companies, not so much. But either way, this company deserves to be on the list. Moving on to the next company is also maybe a controversial one, and that's the Walt Disney Company. Now, with the Walt Disney Company, it's quite important to note that they are still going to look for who's going to replace Bob Iger. And that's probably an important and crucial aspect of the next, let's say, 12 months. Right now, we can see that the Walt Disney Company has a market cap of $203.8 billion and a forward PE of 20.7 times, pays a small dividend as well with a dividend yield of 0.89%. If you look at what the analysts are expecting this company to do, here we can see the same trend, EPS growing faster than sales. Looking at the average analyst price target, that sits close to 9% higher than the price we're at today. And then the pricing metrics, all of them are lower than the 5-year mean. Price earnings to growth, 1.5. Looking at free cash flow for fiscal 25, that's down 10.2%, but then we see growth 14.4% in fiscal 26 and then 13.6% year-over-year growth in fiscal 2027. This company is expected to become more profitable as their streaming side of things become, well, more profitable. And as you can see right here, that's the entertainment operating income that has grown in the last couple of quarters. We've been above $1 billion, and they expect things to become better and better, especially since they are going to start to focus on the quality of the content and not the quantity or the agenda. And I know in the last couple of years, there's been quite a lot of stories and controversies around Disney. Star Wars franchise has basically gone down the drain as well. Marvel also not that great, but I think that they are refocusing the business, and well, we can see that from a profitability standpoint, they are becoming better and better. So that's why it's also on the list. Now, moving on to the last two companies. One is a Meta Platform, one of my better buys in the last couple of years when nobody wanted to touch this name. I doubled down and it's been quite a good performance since. Right now, Meta has a market cap of $1.53 trillion. Year to date, it's up 72.3% and only has a forward PE of 24.9 times. If you look at the expected growth rates for fiscal 25 and 2026, that's still very respectable. Looking at the average analyst price target, that sits 7.6% higher than the price we're at today. And then in this case, looking at some pricing metrics, we are above the 5-year mean, not by much, but for PE, EV to EBITDA, price to sales, price to free cash flow is a bit higher than the 5-year mean. Price earnings to growth sits at 1.41, which again, not that expensive. Looking at free cash flow is expected to increase by 11.4% in fiscal 24, 9% in fiscal 25, and then 13.9% in fiscal 2026. Of course, with Meta, I don't really have to explain much why this business is doing well. Over 3 billion users, one of the most used platforms around the globe, not just Facebook. Yeah, people still use Facebook. They have WhatsApp, they have Instagram. Monetization for WhatsApp is still early days, and I think they're going to be and are right now one of the best positioned player in the AI race. And then, yeah, you might or you might not believe in it, but I'm a big believer in Reality Labs, VR, AR, mixed reality, all of that. I think they're going to be one of the best companies in that field for years and years to come. Moving on to the last company, and that's of course previously known PayPal, now PayPal. Year to date, PayPal is up 43.7% and has a market cap of $88.47 billion and a forward PE of 18.8 times. If you look at what the analysts are expecting this company to do, yeah, it's true that growth is not that great, but for the price that you're paying here and for what I'm expecting this company to do, especially because also it's becoming a company that will grow, but in a profitable way. Plus, there's going to be the advertising side of things that I think will accelerate these estimates here. Looking at the average analyst price target, that sits 6.17% higher than the price we're at right now. And then the pricing metrics compared to the 5-year mean comes at no surprise that we are well below the 5-year mean, but that's because previously this company during the pandemic was growing much quicker than right now. So if we zoom out even more, look at the 10-year, and even with the 10-year mean, we can see that we are below it. Price earnings to growth sits at 1.62, not the cheapest one out there, definitely not the most expensive one. And here, if we look at free cash flow growth, that's expected to grow a bit quicker than sales and EPS. For fiscal 24, free cash flow expected to grow by 44.8%, followed by 12.4% in fiscal 25, and then another 8% in fiscal 2026. And as you know, they are using all of that free cash flow to buy back those cheap shares. And for those that think that nobody uses PayPal anymore, well, for the last 10 years, TPV is up by over 1,000%, active accounts is up by 251%, and the number of payment transactions per active account is up 182.9%. And so that's about it for me right now. Hopefully you're all having a wonderful time with your friends and family. If you enjoy this type of videos, hit all the buttons, would really appreciate that, and I see you all in the next one. Bye-bye.